to deal with these risks. But I agree with you that risks have migrated to that sector, and designation is an important power that needs to be in the toolkit of FSOC.
Well, thank you, Madam Secretary. Look forward to working with you, and I hope you will schedule that as soon as possible. My last question for this round relates to the debt ceiling. My head was spinning this morning when I saw the Speaker of the House say that the recent banking crisis made it even more important that we threaten the debt ceiling in order to achieve major budget cuts, the kind of cuts that have been outlined in the House by House Republicans. You're very aware, I think, of what the risks would be if the United States does not meet its full faith and credit. Do you believe that the recent uncertainty in the banking system means that we should threaten the full faith and credit of the United States in order to pass budgets that one of us on one side of the Capitol or the other may like?
The failure to raise the debt ceiling would cause an economic and financial catastrophe. It would be a failure of the U.S. government for the first time since 1789 to fail to pay bills that it had incurred, and it would cause a loss of confidence in the United States as the safest country, that our currency is a reserve currency used by the world. It would bring untold, unbelievable economic damage. I think this is something that just can't be contemplated. It is a fundamental, basic responsibility of Congress to pay the government's bills. And I call on Congress to expeditiously raise the debt ceiling.
Thank you, Madam Secretary. Senator Hagerty.
Thank you, Chairman Van Hollen. Before I get into my line of questioning, I just want to clarify on the debt ceiling piece. Secretary Yellen, do you think it's not possible to negotiate in any respect the spending package that's been put forward? Is it possible to set aside and agree that our nation's debts will be paid, that we'll pay the interest on our debt, and set that component aside and agree to that before we get to any discussion on specific spending reductions?
I'm not sure exactly what you're suggesting here. President Biden has indicated that he is more than willing to discuss an appropriate path for spending and taxes and the overall deficit, that it's important to have a fiscally responsible budget plan, and that these are certainly appropriate matters for discussion between the White House and Democrats and Republicans in the Congress.
Indeed.
He looks forward to doing that, but not under the specter of destroying the country's economic and financial.
I think the specter that's being presented is a false choice. And the specter that you present does not have to be that. We are facing an unprecedented spending epidemic. We're in a deficit spending situation. We have $31 trillion of debt moving higher that we're parking on the backs and the shoulders of our children. If we don't address it in a responsible manner ourselves, the capital markets will address it eventually, and I think that'll be far more catastrophic. So we have to find a way to talk about this that doesn't pit ourselves with this doom and gloom scenario, and that we find a way to actually address the...
Senator Hagerty, President Biden has submitted to Congress a budget that has, over the next decade, $3 trillion of deficit reduction. It invests in our workforce, in our economy.
And it massively increases taxes at a time when we're trying to recover our
supply.
economy. It's a non-starter on both sides of the aisle, as you know, Madam Secretary. Let me get back to the questions that I wanted to entertain with you, though, today. As I mentioned in my opening statement, I've been tracking the Silicon Valley and Signature Bank situation in very close detail. The situation was caused by a remarkable set of failures, in particular the Silicon Valley Bank situation, failures of management, failures of Fed oversight, and failures of how we responded to it. Both President Biden and in your opening remarks just a few minutes ago, you unequivocally stated that no losses will be borne by the taxpayer. for the actions that have been taken by the Fed, the Treasury, and the FDIC in guaranteeing that all insured deposits at Silicon Valley Bank and Signature Bank that followed the failed auction of SVB, that none of those will be borne by the taxpayer. I understand why that claim is politically appealing, but it's impossible to square with how these programs actually work. As you know, the systemic designation used in the guarantee of SVB and Signature Bank's deposits relies on the FDIC's Federal Deposit Insurance Fund, which will be replenished in the case of a loss with a special assessment on banks across the nation, which inevitably will be passed along to all bank customers, which last time I checked were American taxpayers. So as we saw with Signature Bank, the estimated cost to the Deposit Insurance Fund for this resolution alone is $2.5 billion, which will be paid for by fees assessed to banks across the nation. Is that correct?
There will be a special assessment to this, so it's only an estimate, the $2.5 billion. We don't really know what the final cost
I understand.
will
I think
be, but there will be a special
If you add SVB, it's going to become much,
banks.
much larger. And when you increase the cost of doing business, that cost is going to get passed on to customers. So this number, $2.5 billion plus, and any future losses will be in fact borne by bank customers across the United States. Again, American taxpayers, the last time I checked. Is that
Well,
correct?
they may be borne by shareholders of the firms.
I think the fees tend to be passed on to the consumers. I'd like to turn to news reports yesterday that Treasury is considering whether the administration can order an unprecedented expansion of FDIC coverage to guarantee all uninsured deposits. As was reported, this facility would be backed by the Exchange Stabilization Fund, which was created to support the value of the U.S. dollar in international markets, not as a slush fund when consulting Congress may be inconvenient. I'm deeply concerned by these reports, as such a program would not only constitute a misuse of the ESF, but it would circumvent Congress's role in approving such an action. So, Madam Secretary, does insuring every deposit at every FDIC-insured bank in the nation over $250,000 require congressional approval?
This is not something that we have looked at. It's not something that we're considering. All that I have said is that when the failure of a bank is judged by supermajorities of the FDIC board, the Fed board, and myself in consultation with the president, when such a failure is deemed to create systemic risk, which I think of as the risk of a contagious bank run, that we are likely to invoke the systemic risk exception, which permits the FDIC to protect all depositors, and that would be a case-by-case determination.
I understand.
I have not considered or discussed anything having to do with blanket insurance or guarantees of all deposits.
2 points, Madam Secretary. One, I would encourage you, if you do consider something broader than the basic $250,000, to remind you that congressional approval is required of that in the form of a joint resolution. Two, the program that you just stated really suggests to many people in America, certainly people in my home state, that there's a two-tier system of insurance here in America. For those that are deemed to be systemically important at the time, and those that are not. I think many Tennessee banks are concerned that they would not be deemed
I would
systemically
disagree
important,
with
and that
that,
is
Senator
concerning.
Hagerty, and I said explicitly in remarks I gave yesterday to the American Bankers Association, which is mainly consists of community banks, that this is not a question of invoking it for large or medium-sized banks, only that the failure of a small bank, of a community bank, could likewise trigger a run on other banks and lead to the same judgment that the failure of that community bank creates systemic
I think
risk.
more clarity here would be appreciated. Thank you. And I want to turn to one more point that you and I have discussed on a number of times before in a very short period of time that I have. This has to do with the ProPublica leak of taxpayer information. We've met now, this is the fourth time you and I have met about this. The fact is that ProPublica was a leaker or somebody at the IRS, or somehow ProPublica has leaked confidential taxpayer information. It's been nearly 2 years since this occurred. Has anyone been held to account?
I'm as frustrated by this situation as you are. I would love to know who's responsible for that. And I'm afraid that I know no more about this than I did when the leak first occurred, we did what I believe is the appropriate thing, which is to refer this matter to independent investigators, the Treasury Inspector General, the IRS Inspector General, and the Department of Justice. And there are
no
three
reports?
independent investigations that follow their own timelines, and I can't tell you when they're going to be concluded. I would suggest that you ask those investigators when they think it might be concluded. I would really like to get a report, and I think this was a very serious matter and deserves an independent and thorough
It
investigation.
damages the confidence of taxpayers in America.
Thank you, Madam Secretary. As I said at the outset, the Appropriations Committee has a new chair, and I'm pleased that she's joining us today. Senator Murray.
Well, thank you very much, Chair Van Hollen and Ranking Member Hagerty. As Vice Chair Collins, who is also here with us today, and I made clear when we announced our plan to return this committee to regular order, we have a responsibility to deliver for the American people by working together to draft and pass funding bills that strengthen our economy and keep America competitive on the world stage and make sure that our families here at home are financially secure and thriving. This is no small feat, as we all know, but this hearing is really an important reminder that when it comes to keeping our nation strong, secure, and competitive, it is not just about how much we spend on defense, which is important. It is also important how strong our economy is, and I mean on Main Street, not just on Wall Street. And as we've seen, the collapse of the Silicon Valley Bank and Signature Bank have been a really stark reminder of the important role Treasury does play, regulating our banks, ensuring our economy is sound, and protecting American workers and savers from paying the price for Wall Street's mistakes. And that's really critical because working families are the backbone of this economy. And that means when our families are less financially secure, our nation is less financially secure. Strong funding for Treasury means strong enforcement of our sanctions against Russia and Iran, the drug cartels, and other dangerous actors. It also means when my constituents call the IRS with a question about their taxes, they can actually get a real person on the other end of the line. And thanks to the funding that Democrats passed, the IRS is now answering 90% of its phone calls. That is a dramatic improvement from the 13% last year. But we still are playing catch up on these investments. The technology that handles Americans' tax returns, for example, is over 60 years old. So we need a modern IRS, and that won't just mean fewer tax cheats stifling families when it comes to paying their fair share. It means that Americans' personal financial information is safer from cyber attacks or nefarious actors. And it will mean we could put more money back in families' pockets when it comes to the tax refunds and relief that they are entitled to, like the child care tax credit President Biden proposes reinstating in this budget. Secretary Yellen, I asked you about the IRS spend plan for the IRA funding in our call when we talked last month. Congress still doesn't have that. And I want to join Chair Van Hollen in saying the department has had enough time to produce it, and we expect to see it. And lastly, families, of course, are also counting on us to raise the debt limit. You just talked about this, without drama, without delay. And let me just be clear as you were, that the full faith and credit of the United States, that is, to pay our bills on time like every family is expected to, is not something that should ever be held hostage to score cheap political points at the expense of working people in this country. Not getting that done would be catastrophic for our economy. So I hope we can do this in a straightforward, bipartisan way, as we have many times under both Republican and Democratic leadership. So again, thank you for being here today. And I just want to say I'm going to be very closely paying attention to the work on the issues raised by the Silicon Valley Bank and Signature Bank, and I expect that you will keep us updated on this as we move along.
Yes, of course, I'd be glad to.
Thank you. In terms of questions, last year I was able to pass a sweeping bipartisan retirement bill in our Secure 2.0 Act that will increase families' financial resiliency and help more families save for a dignified retirement and make it easier for businesses to offer retirement plans. Can you tell us what resources Treasury will need to implement all of Secure's directives in a timely manner?
Yes, there are some resources that Treasury will need, and they're included in the 2024 budget. My understanding is that the Bureau of Fiscal Services will need about $10 million to complete their effort to digitize savings bonds. The Office of Tax Policy will need about $1.5 million to hire additional OTP, Office of Tax Policy staff to write the regulations and rules. And IRS will be faced with implementation of many of the features of this, and there's money included in the budget. I believe an additional $10.5 million for IT funds and an additional roughly $5.5 million. And this would go from fiscal 23 through 27 for additional lawyers and the chief counsel staff.
Okay, thank you for that summary, and I'll be following that very carefully as we put this bill together. As I mentioned, I do expect from you a detailed plan about how the IRS is intending to use the IRA money. Without that, we're hearing all kinds of conflated things about 87,000 people in an army, kind of thing. Tell us when we're going to see that plan so we can see the detail of how
In a matter of weeks, I have seen a draft of the plan. It's not final, but you should see it very shortly.
Okay, we need to see that because it is really important for our taxpayers to be able to call the IRS and get a response. It is really important for us to be able to have the new technology we need, but we need to see your SPAN plan so we have a real concrete plan in front of us.
You will see that.
Okay, and finally, I know President Biden's 24 budget is rightly called a blue-collar blueprint to rebuild America. And that blueprint would not only help families with lower health care costs, but also invest in quality child care, ensure giant corporations and billionaires pay their fair share, a lot more. But I wanted to ask you, do you think that the president's budget would increase inflation or put us on a path to fiscal ruin, as some of our colleagues have suggested?
No, I don't. It does invest in America, in our people, in our economy, in ways that will make it more productive, but it proposes ways to pay for that. And in fact, over 10 years, it involves deficit reduction amounting to $3 trillion. So it puts us on a more secure and prudent fiscal path. Many of the investments that are proposed could be viewed as expanding supply. Senator Hagerty mentioned the importance of supply, and inflation's a matter of supply and demand, and the supply side of our economy is important. We know that private investment, capital formation matters, and that's what traditional supply-side economics has always focused on. I've coined the term modern supply-side economics. I believe the supply side of the economy is important, but there are other kinds of investments that are also critical, and that's what's included in this budget. Funding for education, human capital, investing in people, investing in children, in child care, early childhood education, enabling more people to work, investing in research and development that improve our technology and productivity. So there are very significant investments in our economy that will expand its capacity and ability to supply goods and services.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Madam Chair. And now we'll turn to the ranking member of the full committee, Senator Collins.
Thank you very much, Mr. Chairman. It's great to be here with you and the ranking member, and appreciate it. Secretary Yellen, I want to talk with you about the consequences of the decision that was made by Treasury in consultation with the Federal Reserve and the FDIC to use the systemic risk exception in the Federal Deposit Insurance Act to insure all of the deposits of Silicon Valley Bank. Last Wednesday, the new CEO of this bank held a conference call for concerned clients, and he urged them to return all of their deposits to the bank. And here's what he said on that call, and I'm going to quote it. "There is no safer place in the U.S. banking system to put your deposits," end quote. I'm very troubled by that comment because it invites deposit flows from well-managed, prudently invested community banks to a bank that was poorly managed, that took excessive risks. And it seems to me, by guaranteeing all of the deposits, that you're creating a situation where they are immune from losses, draw in deposits from well-managed banks in a way that puts the well-managed community bank at a competitive disadvantage. So I guess my question to you is, how is this fair?
Well, look, we invoke this systemic risk exception because Silicon Valley Bank had experienced a calamitous run, a run that was so enormous that it overwhelmed the liquidity of this bank, its ability to arrange liquidity. And it created the potential for fear about the safety of uninsured depositors in many other banks, and a failure to protect those who were uninsured depositors in this bank at the time it was put into receivership would have led to fears by uninsured depositors at many other banks who really have no easy way of knowing what the status of their banks are and whether or not their funds are at risk. It risked contagion throughout the banking system. We invoke this exception in order to try to contain the contagion that seemed to all of us to be inherent in these uninsured depositors being wiped out or severely haircutted. So it wasn't a question of protecting that bank or that group of uninsured depositors, but rather the implications for the broader banking system because of the contagion potential.
Well, I want to switch to related but different topics, but to me, it creates a situation where you're rewarding very wealthy depositors and you're creating the need for a special assessment that's going to be imposed on those well-managed community banks that didn't take those risks. And from what the bankers I've talked to tell me, the majority of their depositors fall under the $250,000 limit, while at Silicon Valley Bank, the opposite was true. But let me follow up on a point that Senator Hagerty made. He asked you about the level of FDIC insurance. I remember in 2008 when it was raised from $100,000 to $250,000 during that financial crisis. Now, some of our colleagues, including Senator Elizabeth Warren, has recommended that we raise it to $2 million or even up to $10 million. Do you agree with that?
You know, what I'm focused on right now is trying to stabilize the banking system, and I know our banking system to be sound, and I think right now we need to focus on improving the confidence of the public that we do have a sound banking system. And we can debate in the days ahead whether or not 250,000 is the right level for deposit insurance, or whether that system should be changed in some way. I'm not going to weigh in on it. I believe there's plenty of time to have reasoned discussions about that. For now, I want to use the tools that we do have at our disposal to improve confidence and make sure that banks that are faced with deposit outflows have adequate access to liquidity. The steps that the Federal Reserve took in the aftermath of that bank failure to make liquidity more broadly available to support deposits, that's an important step that went with the steps that we took as well.
Let me very quickly switch to a different issue. You said in your statement that the IRS is answering 1 million more calls than last year. That sounds good, but the fact is that the Inspector General for Tax Administration calculates their own caller response figure based on the data they collect from the IRS. And for this filing season, through March 4th, the Inspector General calculates that the IRS has only responded to 52% of calls, and that if you add together both automated calls and calls answered by an IRS customer service representative, that the number of calls that are answered declines to even more, to only 29% of the calls are answered by an IRS customer service representative. So I hope we will follow up and try to get to the bottom of that. I can tell you, based on the casework in my offices in Maine, and I have 6 offices, that they are having an extremely difficult time getting answers from the IRS.
Senator, I would be glad to look into that. I'm not aware of the report that you just mentioned. We have been tracking on a weekly basis the IRS's performance during this tax season, and it has been running between 80 and 90%. That's a very different number than you mentioned, and I would be glad, I will ask my staff to try to reconcile that discrepancy. But I personally promised that this tax season that, so I don't know if are you talking about the entire year or since the tax season opened?
Tax season through March 4th, and it's a report by the Inspector General for Tax Administration.
I will look into that because I've been told its average is 85%, in line with the promise that I personally made.
Thank you.
Senator, thank you. Thank you. Senator Heinrich.
Thank you, Chairman. Welcome, Madam Secretary. We've had some discussion here on the deficit, and I thought it might be helpful if you could remind us of the relative role of the Trump tax cuts in creating the current structural deficit.
Well, the Trump tax cuts added hugely to the deficit. As I recall, it was something like $2 trillion over 10 years. Yeah. And so that is a major contributor to the deficits that we have.
Pivoting quickly to the banking situation, as chair designate of the Joint Economic Committee, I was very pleased that the administration acted quickly to ensure that small banks and depositors don't take the brunt of the Silicon Valley Bank failure. But I also suspect that this is a disaster that could have been prevented. When Congress voted to roll back key regulatory provisions back in 2018, I was also vice chair of the JEC at the time, and I warned that weakening these rules put the health of the banking system at risk. And in fact, I released a report, a JEC report, that named SVB Financial Group specifically as one of the banks that would face nearly none of the enhanced regulations originally put in place in the Dodd-Frank legislation. How can regulators shore up confidence and stability in this asset class of banks? And do they need additional tools in order to improve the stability throughout the entire financial system?
So I absolutely think that it's appropriate to conduct a very thorough review of what factors were responsible for the failure of these banks. And it is true that there was legislation that weakened bank regulation, and there were also regulatory decisions by the Federal Reserve and other banking agencies. There's also a question of supervision and how that's conducted. I was pleased to see that Vice Chair for Supervision, the Fed's Vice Chair for Supervision, Michael Barr, is undertaking and will report by May on an investigation of what's involved. And certainly we should be reconsidering what we need to shore up regulation to prevent this. This was a very unusual set of circumstances that Silicon Valley Bank faced. It appears that they had significant interest rate risk that they were subject to, and an exceptionally high, over 90% of their deposits were uninsured, and that is,
That number is well
potentially-
outside of the norm.
So in that sense, this was an unusual bank, but I think it's appropriate to review all of that.
Do you have any thoughts at all on the nature of, I mean, this is basically our first digital bank run in a way, the way that the fire sort of spread.
Yes.
How should we be thinking about that in the role of providing proper oversight and de-risking these financial institutions going forward, given that that is very much the world we live in now?
So this was an overwhelmingly rapid run on a bank. To the best of my knowledge, we've never seen deposits flee at the pace that they did from Silicon Valley Bank. Now, many of the depositors were, startup tech firms that work with venture capitalists that also bank. And there was, as you say, an internet essentially shouting fire in a movie theater. And perhaps it's the case that now in the world we live in, that although this was a small community with a disproportionate share of Silicon Valley Bank's deposits, this kind of thing may more readily happen now. And it means that in general, when we do liquidity stress tests on banks or think about liquidity requirements, perhaps some of the assumptions that go into modeling the pace at which deposits might flee, maybe some of those need to be updated and rethought. But this is a new phenomenon. We haven't seen this before.
I think it's an important
needs
question.
rethinking.
It's the world we live in today. Some House Republicans recently introduced a bill that would force Treasury to prioritize covering debt held by foreign debt holders like the Chinese government before financing Department of Defense, the VA, really every federal funding priority outside of Social Security and Medicare. You've referred to this plan as default by another name and have pointed out that it's really not logistically feasible for Treasury to prioritize payments given how Treasury operates. What do you think of this plan to prioritize things like foreign investments over current and former service members and other obligations that we have as federal government?
Well, we have a set of bills that come due, and it's our obligation and my obligation as Treasury Secretary to see that those bills are paid, and not some of the bills, and to decide which bills are more important than other bills, simply to pay the bills for programs and spending that Congress has authorized. That's why I say prioritization is default by another name. Not paying any of our bills is default. And when you think about the pain that it would cause to Social Security recipients, to food stamp recipients, you name it, people, to vendors who've supplied services to the government and have their own payrolls to meet, to be told they're not going to be paid, the government isn't going to honor those bills, that's a default. And rating agencies, particularly Fitch, has already clearly indicated that a failure to pay all of the government's bills when they're due would certainly compromise our credit rating. So this has never been tried. It's been rejected by all past Treasury secretaries. And I would say our systems, our payment systems, are simply set up to pay all the government's bills when they come due. They're not set up to divide payments into different types as a general matter and to be able to say, yes, this, and this, we're paying, and these other things we're holding back. For many agencies, payments of all types are all mixed together in ways that couldn't be disentangled.
Thank you, Chairman.
Thank you, Senator Heinrich. Senator Kennedy.
Thank you, Mr. Chairman. Welcome, Madam Secretary.
Thank you,
Madam
Senator.
Secretary, isn't it a fact that the President's proposed budget for next fiscal year is $500 billion more than this fiscal year?
That on the spending side?
Yes. That's what a budget is.
Yeah. It is about $400 billion.
It's about
More
$500 billion
in
more,
outlays.
right?
It's about what?
$500 billion more, right?
About that.
Isn't it a fact that since 2019 until today, I'm not including the extra $500 billion that y'all want to spend, since 2019 through today, U.S. population has increased 1.8%, and the federal government's budget is up 55%. Isn't that a fact?
Well, we had a pandemic.
Isn't that a fact, though? Are my numbers
I'm not,
right?
I don't know those numbers.
You don't know? You never looked at that?
I don't have those numbers in my head. I'm not disputing them.
Okay. Isn't it a fact that the President's proposed budget proposes $4.7 trillion in new taxes?
It does propose significant additional taxes, yes.
4.7 trillion?
Something like that, yes.
Okay. You talked about reducing deficit. Isn't it a fact that under President Biden's proposed budget, that gross debt will rise from $32.7 trillion at the close of this year to $51 trillion by 2033?
I'm sorry, what number did you give me for?
The President's proposed budget will increase gross debt from $33 trillion at the close of this year to $51 trillion in 2033. Isn't that correct?
Well, debt held by the public, which is,
No, ma'am, that's gross debt. Isn't that a fact?
that's probably a fact.
So you haven't reduced the deficit, have you?
The deficit, the debt and deficits are reduced by the president's
How
budget.
can you go from $33 trillion
Because-
to $51
because-
trillion and call that a reduction in the deficit?
Because that's a calculation for which you need a baseline, and then you compare the budget and the deficits and debt in the budget with a baseline in which there are none of the changes, either in revenues or in spending, that are proposed
Here's my
in the
baseline.
budget.
Here's my baseline. At the end of this year, we project people a lot smarter than me, probably not than you, but smarter than me, say that gross debt's $33 trillion. They say if the president's budget is implemented by 2033, it'll be $51 trillion. Isn't that a fact?
If the president's budget is not implemented and none of the changes are made, it will be worse than that. And so the president's budget has improved the fiscal outlook relative to what we would have without the president's proposals.
Even though it raises gross debt from $33 trillion to $51 trillion, you say that's an improvement?
It is an improvement because it raises taxes by more, and it leads to...
That includes taxes. In what world is that an improvement, other than Washington and La La Land?
It's an improvement in that the revenue increases far exceed proposed investments.
Okay. All right, let me ask you this. Isn't it a fact that in January of 2019, the Federal Reserve issued a warning to Silicon Valley Bank over its risk management systems?
I have no idea. I'm not responsible in any way.
But you're in charge of the banking bailouts and the crisis, right?
I am not involved in banking supervision, and I don't have access to any information about the supervision of Silicon Valley Bank.
Okay, so you don't know whether or not the Fed, you haven't looked to see whether or not the Fed issued a warning, 4 years ago to the bank over its risk management systems?
That's not public information, and it's not
Sure it is.
information.
It's in the Wall Street Journal.
Well, it may be in the Wall Street Journal, but it's not public information, and it's not information that I have access to.
Well, I'll give you a copy of this article.
I've read the article, but
The Fed issued a matter requiring attention, and it said your risk management practices are terrible and you need to improve them.
that is what the article says.
Right. Isn't it a fact that months before SVB went under, that the bank disclosed that its mark-to-market value of its bonds was $16 billion less than their balance sheet value?
They did make such a statement.
Did the people at the Federal Reserve just not read it?
I'm not at the Federal Reserve.
I know.
I was at the Federal Reserve.
But you're at the Treasury, and you're in charge of the banking crisis. Let me ask you.
I am not in charge of the supervision of the bank.
Let me ask you this. Senator Hinder talked about the 2018 amendments to the Dodd-Frank Act. Isn't it a fact? Now, SVB was not stress tested in 2022. 34 banks were. Here's the Fed's report. Isn't it a fact that if SVB had been stress tested, it would have passed?
Stress tests look at capital of a bank.
Here's the yes, ma'am, under the stress test. Isn't it a fact that SVB would have passed?
I don't know. It wasn't stress tested.
You need to look into that, Madam Secretary.
This is not my job. This is the Federal Reserve's job.
Okay, isn't it a fact that when the Federal Reserve stress tested in 2022, it only stress tested credit risk, it didn't stress test duration risk? Isn't that a fact?
I believe the stress tests in general partially address and take account of interest rate
No,
risk.
ma'am. I've read it. Here it is, bigger than Dallas.
Well, to the extent that there are assets held in an available for sale portfolio that would suffer losses due to changing interest rates, that would be captured in the bank's
No, ma'am, it's not
capital.
there. I've read it.
Senator Kennedy, I've allowed people the Secretary to stray over answers that were asked before the time went out, but not a series of questions after the time went out. But
Sure, I get it. I understand, Mr. Chairman.
Thank you, Senator Kennedy, and let me I work together with Senator Kennedy on lots of things. We've got a good working relationship. I'm pleased to have done it. We have some disagreements, and some of his questions have prompted me just to ask you some follow-up on some of these issues. I just want to underscore the point you made, that the President Biden's budget, reduces the deficit over the next 10 years by $3 trillion relative to if we did nothing. Is that right?
That is correct.
Right.
That's what I think I said in answer to Senator Kennedy.
Right.
Yes, we need a baseline, then you look at the budget and you compare deficits and debt in the two scenarios. And in that sense, there's a $3 trillion reduction in deficits relative to the status.
Right. I mean, if the Congress packed up its bags and left, which maybe lots of people would want us to do, and the president took no other action, the reality is 10 years from now, the deficit would be $3 trillion higher than it is today.
Yes.
Okay. And isn't it a fact that 1/4 of the total accumulated national debt was incurred during the 4 years of the Trump administration?
Yes.
And isn't it a fact that during the 4 years of the Trump administration, Congress passed the debt ceiling increase 3 times without a lot of drama?
Yes.
And Senator Heinrich asked you some questions about the proposal coming out of House Republicans for some kind of debt prioritization, and you made very clear that that's just default by another name, right?
Yes. Yes. It's not paying our bills.
Right. And isn't it true that back in 2011, I'm having a sort of, this is a
Yes.
flashback on steroids. We
remember
just getting close to that waterfall in the debt ceiling
Yes.
led Sanders and Poor to lower the rating of U.S.
Yes,
Treasury
and
bonds,
that's
right?
why I've asked Congress to raise the debt ceiling expeditiously. We don't want to get to the X date and push this because damage can occur and we could be downgraded if Congress looks like it's
Right.
not willing to do.
I really hope, Madam Secretary, that we won't do that. I do welcome a vigorous debate with my colleagues on the budget issues. Whether you make spending cuts, whether you make revenue increases, people can have a healthy disagreement on that front. But that also does raise the issue of the IRS budget and the $80 billion that was provided with the IRA for a number of functions, one of them being to allow the IRS to collect revenues that are already due and owing and not paid. Now, I have a couple questions regarding that, Madam Secretary. One is you have directed the IRS and the Treasury Department that you will not increase audits above any historical level with respect to small businesses or taxpayers under $400,000, right?
I issued an order to that effect. I have told the IRS that they must not increase the audit rates on either individuals or small businesses earning under $400,000.
Yeah. And I think it was I think it was Jesse James who said when he's why do you rob banks? He says that's where the money is. Where the money is in uncollected taxes is in very wealthy folks who are not paying their taxes on time, right?
That's right. It's wealthy individuals, complex partnerships, corporations where there's particularly unreported income.
Right. And I know that the administration and the IRS have calculated hundreds of billions of dollars of lost income annually from this tax gap. But the CBO has a more conservative number, but it has a number nevertheless from the enactment of the Inflation Reduction Act. And it also calculated that the first act, I think it was the first act of the House under new leadership of Speaker McCarthy, when they repealed the Inflation Reduction Act, according to CBO, that would increase the deficit relative to where we are today by $114 billion, right?
Yes, the money that we spent that you appropriate to the IRS, whether it's the discretionary budget or the additional long-term mandatory investment in the IRS. This is money that brings in net more tax revenues. In that sense, it's not really costly. It generates more money for the taxpayer by enabling the IRS to collect the taxes that are owed than you're spending in appropriations on the agency.
Right. So, I hope in the coming weeks we can have a sober conversation up here about the budget and deficits, because it's one thing for our House colleagues to say they care about the debt ceiling deficit, and another thing for their very first action to be to increase the federal budget deficit by over $114 billion over the next 10 years.
Mr. Chairman, could I ask a personal?
Let me just ask my last question. Sure. I'm happy to entertain a question if my other colleagues are willing. So, Madam Secretary, in terms of the IRS funding, in addition to trying to collect taxes from wealthy tax cheats, we have seen an improvement in IRS performance when it comes to answering constituents' calls. Is that not correct?
That is certainly the reports that I have gotten, that the response rate has been between 80 and 90% this tax season.
And we're going to look at, Senator Collins raised some important questions here. It has definitely improved. Whether it's improved to that extent, according to the Inspector General, we'll have to take a look at that. But I do think that making sure that folks who, especially very wealthy folks, pay their taxes on time is important. And I'm just going to, in closing here, refer you to a letter that a group of us sent on March 20th. Myself, Senator Warren, and others, regarding abuses of trusts that allow very, very wealthy individuals, billionaires, to pass on lots of money without any taxation. They have very high-priced lawyers, which in our view are skirting the law, certainly the intent of the law, and we're asking you to take a look at that. Will you do that?
Yes, we actually have some proposals in the Green Book to clamp down on that type of abuse, and would be glad to discuss further things we can do to prevent that kind of abuse.
Got it. Senator Kennedy, it's up to Senator Haggerty, but I'm happy to.
Well, I just wanted to ask, this is a question, not a comment. Are we all going to, my colleague here hadn't had a chance to answer and ask any questions. But will we have a chance to follow up as well with the Secretary?
Sure. We're doing another round. We have 7 minutes each. Absolutely. Absolutely. Senator Bozeman.
Thank you. Thanks for the pep talk. Thank you, Madam Secretary, for being here. And I'd like to ask some questions that my community banks in Arkansas are concerned about. It's important to remember that Silicon Valley Bank and Signature Bank took on unique risks and were materially different from most U.S. banks, especially rural community banks who are safe and sound. In light of those unique risk profiles, and understanding that you aren't the FDIC chair, when determining whether to invoke the systemic risk exception, what specific data points, metrics, and factors do regulators focus on?
Well, we were very focused on the potential for the failure of these banks and losses to uninsured depositors in the banks to trigger runs on other banks. And we looked at things like deposit outflows from other banks, anecdotal reports that we heard. I will say that many mid-sized banks expressed great concern that they have uninsured deposits. Often these are local businesses that can't operate within the insured deposit limits, and these banks felt seeing many uninsured depositors having the view the only place you're safe is in the largest banks. Many of these banks felt very skittish about their potential to suffer runs as well. And I have heard this in many banking contacts that my staff and I have had in recent days, that there is concern. We can see that banks across the country are shoring up their liquidity. They are very worried about contagion from the troubles of Silicon Valley Bank and Signature Bank. And the steps that we took were designed to improve the confidence of all depositors that they're safe in banks. And, you know, depositors often don't know about what the specific situation is of their bank, whether it's a mid-sized bank or a community bank. And if they become worried, they can pick up their deposits and go someplace they think is safer. And we did not want to see contagious runs that could have impacted many banks, including community banks.
Very good. While Silicon Valley and Signature's uninsured deposits will be paid for by the Deposit Insurance Fund, banks will replenish the fund via special assessment. In reality, those costs will pass down to customers via higher banking cost, and I'm concerned that Arkansans will have to subsidize Silicon Valley Bank and Signature Bank's deposits, and maybe others, that come forward. What specific legal authority exists for Treasury, FDIC, and/or the Fed to exclude certain banks from being charged the special assessment? And will the community banks get charged that special assessment?
I don't know what the rules are around that precisely. I think the FDIC may have some ability to determine which banks are charged. I believe it's up to the FDIC to make that determination.
And again, absent Congress passing a new law, what specific authority does Treasury, FDIC, and/or the Fed have to guarantee, even temporarily, all uninsured deposits of open banks?
Well, I mean, the FDIC, if it wished to put a program in place like the TAG program that I think was instituted in 2008, that requires congressional approval.
Okay, very good. Thank you. Turning to a different issue, can you provide a timeline for when Treasury and/or IRS will write any further rulemakings, guidance, or notices regarding the Inflation Reduction Act's direct pay provisions relating to tax-exempt entities?
You're referring to the IRA?
Yes, ma'am.
We have many rulemakings we are required to do to implement the features of the IRA, and we are frankly working 24/7 to get them done as rapidly as we can. I can't give you an exact date, but I can tell you that we're working on it very hard. We're full tilt. These are some rather complex rules, and we're working very hard to get them out.
Good, thank you. The CDFI fund is in the process of finalizing changes to its CDFI certification application. What analysis has Treasury done to understand the impact that the application changes will have on currently certified CDFIs? How will the changes impact recipients of ECIP funds? Also, will depository institutions be less likely to meet certification requirements under the new standards? And if so, what impact will that have on the fund's ability to support investment and access to capital in underserved communities?
So I really need to get back to you on that. I'm not knowledgeable about the details of the change that you're referring to. Certainly the CDFI fund is trying to get money into the hands of CDFIs to lend in underserved communities, and certainly not to make it harder. And my staff will get back to yours if that's okay.
Yes, ma'am.
On the details of the question you asked.
Well, thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Bozeman. Senator Hagerty.
Thank you, Chair Van Hollen. Just a couple of follow-up questions. One, I'd like to follow up on a point that Senator Kennedy touched on, Secretary Yellen, and that has to do with the crisis that we just experienced with the banking community here. And as the mantra of Washington seems to be, never let a good crisis go to waste. There have been calls now that there need to be re-regulation, that the tapering, I was not here when this was passed, but that the tapering that Senator Kennedy mentioned back in 2018, S2255, that was meant to take the one-size-fits-all regulation and try to, in some way, make that better fit the market, that is the reason for the failures that we've seen. What we've seen is a failure of management, as I mentioned earlier. You've got a management that was asleep at the wheel and out to lunch. They left their chief risk officer position, stay open for 8 months up to the failure. I'm not aware of anything in S2255 that would have fixed that problem. Are you, Madam Secretary?
Look, you know, we need to do a thorough review of what happened in the case of these bank failures, and I'm not prepared to weigh in on precisely what the causes were at this point.
I will weigh in a little bit further then, if
Certainly.
you'll accommodate me. There was also a failure at the San Francisco Fed in terms of the oversight that they should have been providing. Again, they were getting detailed liquidity reports, I believe, on a monthly basis about what was happening at Silicon Valley Bank, yet they didn't seem, they didn't seem to identify the problem, nor did they address it in time. And I think the most disappointing failure of all is what happened during the weekend, that the auction should have taken place. And rumors were rampant about slowness of the process, whether people were being encouraged or dissuaded from bidding. And at the end of the day, my understanding from an FDIC official was that they did have a bidder, but they were not able to conclude the auction. We would be in a far better place right now had the FDIC concluded that auction. We were talking about a new buyer of the bank, and we were in a position at this point to have contained the loss to, again, this example, Silicon Valley Bank, as opposed to finding ourselves in a position where we have a much broader situation, where there's a precedent that's been set now that, again, make many people in America wonder whether every deposit in America has been, in some way agreed to be backstopped or guaranteed. You have articulated the decision process that you would go through on a case-by-case basis, but I think, again, as I mentioned earlier, the bankers in my home state of Tennessee are very concerned whether they would be included or not, and there's a lot of uncertainty that we're going to have to get to the bottom of there. From that point, though, I'd like to turn to just another issue, Secretary, and that has to do with the President's budget. The new budget lays out another $2.5 trillion of spending increases, and going to the Treasury Green Book that you just mentioned a few minutes earlier, another $4.7 trillion of tax increases as well. Those tax increases, in my view, as you look at the Green Book, will have a lot more complications. We've already got an overcomplicated tax code. I think this promises to overcomplicate it further. The most recent estimate that I've seen shows that individuals and corporations spend 6.5 billion hours on tax filing and reporting already. And it's hard to imagine a system as complicated and as bureaucratic as it already is getting more simple with the addition of another $4.7 trillion of new taxes. And my question of you, and you may need to get back to me on this, is how many more forms or instructions are going to be required from the IRS to the American public to address this? And how many more hours will be required to fill out new forms and new overhead to address this massive new tax increase?
Well, I can't give you an estimate at this point of the number of hours or forms, but if Congress would consider seriously the proposals, we would be able to make estimates of those things.
I will certainly consider it seriously, but it's clear to me that it's not going to get any less complicated. It's going to be more complicated considerably by the way it's moving. And I'll just finish with this. I'm very concerned, again, that the Green Book calls for more than $100 billion in targeted tax increases on fossil fuels. And talking about further increases on fossil fuels, further complicating that business at a time when our economic security and our national security are in such a grave situation. I think it really doubles down on the weaponization of our tax code against industries that are out of disfavor by this administration, and it weakens us as a nation. Anything that would lower investment in energy production right now will weaken our national security, so it's a grave concern.
I would say that fossil fuels have benefited from many special tax features that really are tax expenditures. They've benefited from that for decades, and at a time when we need to make a shift over time to clean energy, to be spending money to subsidize fossil fuels through the tax code is something that doesn't seem to our administration to be appropriate.
Anything that increases the cost of producing energy right now at a point where we've had massive inflation in energy cost, and we're at a point right now where we cannot fulfill our obligations to our allies, it's putting our nation at a point of weaker economic security, weaker national security. I think we should not be doing that. Thank you, Madam Secretary. Appreciate you being here. Mr. Chairman, thank you.
Thank you, Senator Hagerty. And I'm going to turn it over to Senator Kennedy. Just one piece of business before that. If I run out before Senator Kennedy's finished asking his questions, I just want Scout's honor, you'll stay within the time limit. Number one, I know you will. Thank you, my friend. And number two, in case I can't get back, let me just say, Madam Secretary, thank you for appearing before the subcommittee, and members will have 1 week to submit questions for the record due on March 29th, and we would appreciate if your office could respond to those questions as soon as possible. Again, I will be here unless I get called away to get my questions up in another hearing. Thank you, Madam Secretary.
Okay.
Senator Kennedy.
Thank you, Senator.
Scout's honor, Mr. Chairman. Madam Secretary, I thought I understood your proposed budget. I want to walk you through it again. Isn't it a fact that the President's proposed budget increases spending by $500 billion over the current budget?
There is an increase in 24 over 23 by about that much
Okay.
in outlays.
Isn't it a fact that the President's budget proposes new taxes of $4.7 trillion?
That's probably right, yes.
Okay. And isn't it a fact, I'm talking about gross debt now, not public, not debt held by the public. Isn't it a fact that under the President's proposed budget, gross debt would go from $32.7 trillion at the close of this year to $50.7 trillion by 2033?
Debt subject to statutory limitation, yes, would go, as you said.
So the President's budget would increase our debt by $18 trillion.
Which is $3 trillion less
Right.
than it would increase without the proposals in the president's budget.
So what the President's saying is, these are my words, not his, because of his budget, we're going to have 3 heart attacks and a stroke instead of 4 heart attacks and a stroke.
Well, I would not agree that we're going to have 3 heart attacks and a stroke because we have a very large economy, and while the numbers that you cite are very big numbers, the size of our economy is also extremely large. And I think a better metric for assessing what the impact of the budget is on our economy and whether or not it's manageable is real net interest on the real net interest payments that we have to make relative to the size of our economy. And those real net interest payments run throughout the 10 years of the budget at around or under 1% of GDP, which is historically normal. So debt is increasing, the size of the economy is increasing, interest rates are moving back toward more normal levels after a period of many years in which they were exceptionally low, and yet overall, what you see in this budget is real net interest on the debt stabilizing at about 1% of GDP, which is a manageable and historically normal number.
So $51 trillion of debt up from $33 trillion doesn't bother you?
I think the path that is set out in the president's budget is fiscally sustainable.
Okay. Well, how much debt is too much? Tell me that.
Well, I just gave you the metric that I think is best for assessing fiscal sustainability.
Okay. Let me ask it in simpler terms. I didn't follow you there.
It's
What percentage of our GDP, what debt as a percentage of our GDP is too much?
so it depends on what interest rates are. And real interest rates have been extremely low. This budget and previous budgets have projected that they would move up toward more normal levels over time, but certainly not the levels that we saw several decades ago. And
Could you
we
just
can't
answer my
judge-
question, Madam Secretary? What percentage of our debt of our GDP is too much?
Well, this budget has debt held by the public moving up to around 109% of GDP.
And that's not too much, in your opinion?
Historically, it's a high level, but on the other hand, interest rates, real interest rates, have moved down substantially in recent decades. And so higher levels of debt to GDP are sustainable with lower real interest rates. And on balance, as I said, the interest burden of the debt is at a level that is quite reasonable in historic terms.
Madam Secretary, are you a Keynesian?
Well, I don't quite know what you mean by that, but I've certainly
Well,
studied
do you
Keynesian.
believe it's acceptable, indeed, it's admirable for government when you're in a slow period, a recession, or bordering a recession, to stimulate the economy by borrowing money and spending?
It certainly can be. I certainly,
That's
there
what I
are
mean.
different.
That's what I mean by Keynesian. Do you support that?
Well, there are different tools that can be used to stimulate an economy that's in a downturn, and it's monetary policy is an alternative tool. And
But let me go back to my question. Keynes said that when you're in a recession, you can borrow money and spend it, government can, to stimulate the economy and get you out of the recession.
Well, I'm not going to make a blanket statement that I agree with that.
Well, let me ask you if you agree with this. A lot of people who say they're Keynesians, and based on what I've read of your writings, you are a Keynesian.
But
They forget the second part of what Keynes said. He said after you get out of the recession, you pay the money back. Did he not?
I don't recall that he said that.
He said it. I can show you that one too.
Well, show that to me.
I promised the chairman I wouldn't go over, and I want to yield back 2 seconds.
Thank you, Senator Kennedy. And I'm hoping that you would agree that all economists would agree that it's a bad idea to default on our debt as we still try to figure out how to deal with these budget issues. And I look forward to a conversation. This has been a good, I think, good discussion for all. Thank you to the members. Madam Secretary, thank you. And the hearing is adjourned. Well, Madam Secretary, I have Senator Manchin has just arrived. I'm going to give him 7. I'm going to, as I said earlier, Madam Secretary, I'm going to have to depart. My other colleagues here may have to depart. We'll give 7. Yeah, thank you, Senator Kennedy. But Senator Manchin, you've got 7 minutes. And I'm going to you'll close out the hearing. All right? Thank you.
Thank you so much. I am so sorry to hold everybody. I'm so sorry. I'm glad you stayed.
Sure.
Madam Secretary, I know we have an awful lot to talk about, and you know, you've been so kind and sharing, giving me some of your time in a meeting with you. But I think on the record, I'd like to have a few things that we can talk about on the record and make sure that we do. First of all, you know, with all this going on, I know there's a lot of talk about the bank and this and that. And I think it was Senator Hagerty was talking about over the 250. I've been talking and to a few of our colleagues, and we were just wondering if it's, and you said you haven't gotten to that point yet. So let's say 90% of my West Virginia depositors are under 250. And now they're going to pay a little bit higher premiums, I guess, or higher bank fees, or somebody's going to pay. Is the bank absorbing that, or will it be passed on to the consumer?
Well, it's not obvious it would be passed on to the consumer. I suppose it could be, but may also be absorbed by it's a special one-time
I got you. So
assessment.
if we're assuming that could happen, and maybe it could be the consumers, okay, they understand, you know, and the bankers, I had all the community bankers in. What they believe would be unfair, they said, listen, we're in good shape. We move money around. So if we have a depositor has $1 million, this one banker says, you know, I'll call 3 of my friends and say, can I move 250 to you, 250 to you, and 250 to you? We do that all the time to make sure everyone's covered. That's my response. He said, that's my responsibility. Which made all the sense in the world. So I know there's a lot of tools that we already have that sometimes just bad banking practices. They all come to the conclusion they felt the San Francisco feds did not do their job. They thought they were, you know, lax in basically what they should have enforced. There was 8 months without a risk manager at the bank, SVB, that they knew of. Is that factual?
Senator Manchin, I'm not involved. It's the Federal Reserve and California that are involved in the supervision of that bank. I'm not involved. I've read some newspaper stories about this, but this is not in the public domain, and I don't know.
Well, for the record, I think you did the right thing. We all made your decision on taking care of depositors, but not the bank bailout and not the shareholders and all that. And I think there's a clawback. You understand there's legislation for clawback.
Yes.
Because we think that there was nefarious acts by those responsible to protect themselves and the heck with their depositors and all the other people who've fallen prey to this. So we're hoping that you all can look at that and maybe give us your blessing.
Yes, certainly.
And in
we
a
will.
250 above, I was
Absolutely.
just going to ask you this. From 250 and above, it was, to me, the reasonability would be if I need to keep about $2 million in the bank because of payroll and inventory reasons, and I know I'm only secured at 250, I got $1,750,000 at stake. Shouldn't I be able to buy or pay a little higher bank fee to get protection up to the amount with a cap maybe at 10, something? We've been talking, some senators have been talking back and forth. Could the FDIC, and I think they say it would take legislation.
It would take legislation.
I don't think we should do it without you all involved, showing us how to structure that. But if I could go back to my bankers and says, for those businesses you might have in even rural areas that have to keep large amounts of cash because they need that, now that they know that they're exposed, they would be the first ones to move to the bigger banks.
That's exactly right.
So they're worried about that.
Yes.
And they said, if you could offer some type of an insurance policy that they would pay for, so the $250,000, 80 to 90% in rural areas aren't going to be saddled with accommodating somebody that needs that type of protection.
I think often the uninsured depositors, especially in community banks, are local businesses that have payroll and can't manage with
Does
just
that type of
within the
evaluation make
insured.
sense to you? Does it make a?
I think this is very worthwhile, for you and your colleagues to be discussing what's appropriate here, and we would be more than willing to work with you to think this through. It's worthwhile. Look, for the moment, we're trying to stabilize the situation using the tools at our disposal, but there certainly are.
Yeah, we just, I mean, these are questions asked by reasonable people in the business.
course,
And they're just saying,
Yes.
if you're going to do something, rather than just now saying, they think, if you set a precedent now that they're expecting the feds to bail everybody out,
So
and I don't think that's what our intentions are.
I don't think that that's going to be needed. but we don't want to see contagious bank runs and a loss in confidence in our banking system, especially when the banking system is overall for the United States very sound.
When this subcommittee, hopefully we'll have Mr. Jerome Powell with the Feds telling us basically what they've been able to do since the CVB has happened as far as to enforce the oversight by the San Francisco Reserve and all the different reserves we have around the country, if they're looking at their more troubled areas, if you will.
It's been announced that Vice Chair for Supervision Michael Barr will do a thorough review of the supervision of this bank.
Now, now I know this is in your bailiwick, okay? I know that the White House is currently working with the EU on a limited trade agreement that will allow them to become eligible for the first half of the EV credits. What we're concerned about is, I know that the EU, and I'm fine, I said I don't have a problem with our allies. What I have a problem with is going to countries that we don't have what we would call a secure supply chain. So when we wrote the bill, we wrote it, you and I have spoken about this before, we wrote it with free trade agreements. For us to have a free trade agreement, we knew that there had to be more of a confidence that we're going to have pretty good supply chain and not be held hostage. Some of these other countries where an awful lot of the minerals come from are not in the EU. If you're trying to expand that, if the White House tries to expand that beyond, we're back in that critical situation where we have unreliable supply chains, where the Chinas, the Russias, the Irans, the North Koreans, all the different people who have nefarious activities that sometimes use unscrupulous tactics to hold those people hostage, and they've already had a pretty good stake in it. I can assure you that was not the intent of how we wrote the bill.
Senator Manchin, I understand that the intent of the bill is that we should have secure supply chains, and any agreements that we would look at, and of course we would consult closely with you and with Congress, would be meant to make sure that we are securing our supply chains as the legislation is.
Well, you've been kind. We might respectfully at times agree to disagree on some things, but at least you've been kind enough to sit down and work with me, and I appreciate that. And we want to keep that going. I think we've furnished you with the concerns we had.
Yes.
With production, sourcing critical minerals, and processing versus the manufacturing, and why we think there's a difference there, and why we think it's imperative we keep that difference. Okay. And if we don't keep that difference, then basically this material that they're considering part of the processing, which goes into the manufacturing portion, does not go into processing, and all processing is taking the rocks or the raw materials, or raw minerals, and processing them into a form, then goes into the okay. That's the differences, and we think that's very clear, and we're hopefully that before you all come out with the rule and all that, we have more input in that, or we're on the same page, because that one causes a lot of problems.
So I believe we're on the same page. We're working very hard on the rule and have said that we will get this rule out by the end of March. We're certainly trying to meet that deadline and have been consulting with you and your staff and broadly to understand.
One final question, since I haven't put the clock on myself right now, but I'm watching it very go. Don't tell on me. One final question. Knowing what we have and how critical the financial situation can be, and just what the bank thing, just that one thing, what it did to our psychic, if you will, and our whole, it could have unraveled so many things, right? With the SVB and all that started. When you don't have a financial house in order, and right now, I'd venture to say, what would you recommend that we evaluate in how we operate our government and our finances of our government right now? So we're looking at all these other things. I hear about stress testing and all the things that goes on to evaluate, are they in a critical position or not? What do you think we could do to look at how we operate here? And I want to be very clear. The way that both sides, Democrats and Republicans, are approaching the debt ceiling, there's not one person, as far as out of 100 senators, that I truly in their heart believe that we should not hold anything hostage about paying our debts or missing that or going into default. I really believe that in my heart. With that, I do not believe it's unreasonable for my friends and colleagues on the Republican side to say, can we sit down? Now, if they're going to say, I will not vote to raise the debt ceiling unless you pass this, this, and this, I would not agree. That's a wrong approach. Would we sit down and we can agree that we should be looking at these portions of our debt and how we've accumulated so much debt so fast? We know what we did with COVID. Take COVID out of the picture. We know how the rest of it, or do we know how the rest of it accumulated in such a short period of time, especially since 2001. But even look at 2013, the last 10 years, it's been unbelievable. And the projections from OBM doesn't quit. So it scares the bejesus out of me and all the trust funds. I'm hopefully that we can come to an agreement. And if you all would be receptive to considering, should we come to an agreement that we can basically look at all of these things and within a 90-day period come back with some recommendations and get a vote either up or down? We're not holding anything hostage. We're voting to pay our bills. And all we've agreed on is we're going to put a bipartisan, bicameral group together to look at trust funds, to look at the different things that are very vulnerable, the same as you do with the bank when you send your examiners in.
Senator Manchin, I believe being on a fiscally sustainable course is critical for our nation, and we should sit down and have a very reasoned discussion about what's necessary to accomplish that. The president has offered to have discussions, but not with the sort of Damocles of
Vote for it, or if you don't vote for this, I won't. Yeah, no,
we're going to not pay our bills and have financial and economic chaos.
If I was capable of bringing some people together on both sides and says, listen, let's sit down and talk about what we think, that we could basically come and look at over a 3-month period to come back with a guaranteed vote on the floor if we make recommendations. You don't have to vote for it. And they think, oh, it might be too toxic. I don't care what you think. Let's look and see how we get our finances in order, because we're not right now. And knowing what happened to the bank should put all of us in a concern. Could that happen to our country?
Well, we should be stress testing our fiscal, just as we stress test banks. We should be looking at
we don't,
what
do
we
we?
think will happen in a base case and what happens
Worst case.
in alternative,
But
better and
I've been here
worse
for 12 years,
scenarios.
Madam Secretary, and I've not had that happen or anyone approach me with that. So I'm glad that you've said that, and I think that you're right on. Well, I want you to know I won't participate and will not participate in anybody holding anybody hostage. I will vote for the debt ceiling, but I would vote with the understanding that at least we can have a conversation with a guaranteed vote in 90 days on changes we think need to be made. And I think that's a responsible, reasonable approach. So hopefully you can talk to the White House, and I'll be talking to them too and seeing if they would agree to something such as that.
I mean, I know the president is open to discussions on this topic.
Well, with that, sometimes it pays to be late. I had so many, I'm so sorry to keep this. But let me just say, I want to thank you, Madam Secretary, and your staff for being so accommodating and forthright with us and coming before and appearing before the subcommittee. Our members will have 1 week to submit questions for the record, which are due March the 29th. I would appreciate if your office could respond to those questions as soon as possible. The subcommittee meeting will be adjourned on that.
Thank you.
Thank you.